Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, I'm speaking with George Ross about the most recent volatility in the financial world. George has seen numerous cycles in his lengthy career that spans 7 decades. Whenever I speak with George, I get perspective from someone who's, in many ways, has seen it all. Listen to my conversation with George Ross. Good evening, George.
Hi there.
Looking forward to another great conversation tonight.
Okay, let's get started.
Absolutely. So, George, we're definitely in a turbulent moment, and I know you worked for a number of high net worth families, of course, the Trump family, the Wilpons, who used to own the New York Mets, and Saul Goldman, and countless others. We've seen a lot of angst around deposits in excess of FDIC limits. How have you been involved in discussions around risk management with other high net worth families, specifically around managing large amounts of cash? I've seen a lot of...
Basically, as far as the cash is concerned, the banks are solid. So certainly in the United States, they're solid. What you have is a Silicon National Bank, and actually the bank that I deal with, I've dealt with for more than 20 some odd years, Signature Bank, had the same thing. And it's not that the banks don't have the assets. And it's not that the people, the depositors are in trouble, or should be concerned. It's just that the banks didn't have the liquidity because of certain investments which they have made, which weren't readily liquid. And that's the problem. Once you have a problem, and the bank examiners go at it, or the FDIC goes at it, at that point, and you got banks which that have to be shut down because they don't have the liquidity. But that doesn't mean the depositors are not going to be covered. The depositors are covered. FDIC, as far as the $250,000 limit, then they're not concerned. They'll guarantee everything. So it's not really something of concern. And the truth is that a lot of these smaller banks have much greater flexibility than the large banks. So that flexibility is nice, but it also puts them under a different magnifying glass as far as the Fed is concerned.
Well, it's certainly the whole question of whether a bank having less than $250 billion in assets is, and I think they use the term systemically important. Silicon Valley Bank fell below that threshold, but clearly they were the canary in the coal mine to this issue, representing about $620 billion in unrealized losses. Correct. If all the banks had to liquidate today.
Yeah.
Right. So yes, they're being allowed to hold those treasuries at face value, and they're now, as of Sunday, being allowed to borrow. They've formed a new discount window. They didn't call it that. Gave it a new name, where they can borrow at par without a discount for up to a year, which theoretically should keep everybody safe, which is exactly...
It will, exactly right. No, the assets that they had were good assets.
Correct.
They were not readily turned into cash if they needed the cash. And if the depositors or some major depositors needed the money, it wasn't there because it wasn't the cash. There was a lot of treasuries and a lot of long-term bonds and other assets, which were good assets, but just couldn't be something that you could cash. For example, at this point, a certificate of deposit that you have. Certificate of deposits are good. You put the money in, but you can't take it out short of a year. So it's a time for, and they had equivalent type of assets in a lot of these major banks that were not readily liquid on very short notice.
We're seeing a lot of angst around Credit Suisse, who are certainly much larger.
Credit Suisse is a main player in that type of investments and also liquidity, and they're huge. But as far as, I don't know what it is in Canada, but as far as the United States is concerned, the FDIC and the federal government are right on it. And I wouldn't recommend anyone that has assets in banks in the United States decide they're going to put it somewhere else. One of the problems that's going to exist is the big ones are going to prosper tremendously because they're going to have a lot of assets, a lot of cash pouring in. So you got Wells Fargo and other banks of that nature, Chase. They're gonna have been deluged with cash because investors want to be involved with a big bank. But that's not any safer.
It's not, no.
No, that's the whole thing. It's not really. It's forced liquidity, which is a good idea, but something that the Fed did and they're much more concerned with smaller banks because they should be controlled more. So if you had the same regulations on the big banks that you had for the small banks, you'd have a much bigger problem. You don't have it.
The issue, of course, of if these small banks start to disappear, we as real estate investors,
That's a problem. You
right?
hit a nail on the head. The problem is these smaller banks are much more flexible and they're easy to get money from
Exactly.
because they're local. Generally speaking, you can establish a relationship with the banker or the bank, and they're more flexible. And that's now you're going to lose that part of that flexibility, which is a shame because of the borrowers need that flexibility, and the small banks can do it, or the regional banks can do it, or will do it. It's much more easy to do business with them than it is to do with a huge bank that's got the rules and they don't need you. The difference is the small banks need you as borrowers. The big bank don't.
Absolutely. I mean, if you think, Bank of America, they are not the bank for technology startup companies in Silicon Valley. They are the worst bank to deal with for something like that.
Correct.
Right? Silicon Valley Bank was providing a very real, valuable service to that community, and
Yeah.
now they're gone.
Yeah. Yeah. Which is it's a problem, and unfortunately, it happens. But somehow along the way, it seems to me that somebody at Silicon National Bank, they should have been more on top of it, that this was a possibility, and they could have had areas where they could go out. In other words, you could get other banks that would agree if this situation happened that they'll advance money to Silicon National Bank. In other words, but they don't like to do because you have to pay for that. In other words, if you got some say, yeah, well, the truth of the matter is, if you need $4 or $5 billion, I'll give it to you, but you pay for the privilege of using it, even if you never use it. So that's part of the problem. It's you've been paying for insurance, and they figure, what do I need insurance for? And I think what will happen now is the smaller banks are going to have to protect themselves by dealing with the larger banks and effectively buying some sort of insurance to cover them in the event that they have a immediate need for cash.
I remember in the wake of the financial crisis of 2008, General Electric wrote a check to Berkshire Hathaway for the option to avail themselves of a line of credit if they needed it.
Yeah, absolutely. And I have this is not something new by any means. It's something that's been in existence for a long period of time. For example, when Donald was building Trump Tower, we had a guarantee from a major company, not a bank, but a major company, that if you needed that they would fund, if necessary, up to $350 million. Now, they never funded it. They never funded a nickel. All right, but the fact that you had them on the paper made your construction lender satisfied. If necessary, if your units didn't sell at this, they could look to this major company. Well, a major company, all they did was pledge their credit. Wow. And that's basically what you're going to see here.
Right now, it seems as if the Federal Reserve doesn't want to see a whole pile of counterparty risk, and they want all the banks dealing directly with the Fed as the counterparty. That's what I'm observing.
You figured that out. Good for you.
Yeah.
Yeah. Yeah. And right away, they buy it. They get other companies or other banks, or the Fed steps in and has a bridge company, a bridge loan. until such time as you can get some other entity that's willing to take over the risk, which is not much risk. There was not much risk. There weren't bad investments. They were just time-sensitive investments.
So we as real estate investors, if we find ourselves in a liquidity crunch, as I'm sure you've experienced from at various points in time and Donald has experienced, what's the path? Where do you look?
Well, the path is that point. They're insurance companies they're companies which will guarantee that risk, which will underwrite it if it's necessary. And the reason they'll underwrite it is because most of the times it's not necessary, and they're getting paid for for signing a piece of paper, and the probability of using it is remote. Now, as long as the equity is there and the basic transaction is sound, these companies will do fine. It's just a question. The time may not work out. So if you had to do it tomorrow, maybe it was. If you had the flexibility of doing it in 30 days, that's a different story. But there are a lot of entities that make their fortune in giving their name to projects. There's potential bridge loans, potential construction loans, where the equity is short, and they supply the whatever additional equity was necessary to make the bank happy. You know that if you go in and borrow at that point, the bank says, well, I'll give you a 60% loan or 70% loan or whatever it is. And if that 70% loan was not sufficient, but you needed more, you have entities that are willing to give you the more to cover the gap. Interesting. It's not a phenomenon. It's been going on. It's gone on forever and will go on for years. It's just that all of a sudden this happens because the Silicon Bank did financing of a lot of startups, and the startups didn't work out, didn't get up the cash or didn't sell, and therefore now they have as a result paper that they're going to have to pay out, and they don't have cash. But it's an anomaly, not a normality.
Very interesting. Well, we're living interesting times. Buckle up, everyone, because this is going to be a little bit of a bumpy ride this next little bit.
It will be a little bit of a bumpy ride because the perception is worse than the reality. The people say, oh, I can't trust my bank. I can't do this. I'm going to lose my money. I got $1 million in assets in that bank, and now all of a sudden they're closed. That's a scary thing. And you're right that as far as the United States is concerned, the Fed has basically stepped in and said, don't worry, we'll protect you. It's not a question of whether your assets are insured to $400,000 or $200,000, whatever it is, we're covered, because the assets were good. The depositors' money was good. It's just that what the use of the funds by the banks created the problem. Now, let me put it this way. I'll tell you, as far as the small investor is concerned, or the real estate investor, this is a bonanza. If you have a bank that you have a relationship, you're very high on the list of potential borrowers. If you have to start now with a new bank, with a new relationship, they're going to be very nervous at what they do because they don't have a track record. If you have a track record at this point, you're going to do fine. And I think you find that. You use the same bank over and over again. If they like you and they're feasible, they'll do what they want you to do, what you want them to do, and that's great. That's an edge which any borrower has if he's got a banker relationship. Any new entity coming in doesn't have that relationship or the ability to do that. So you have an edge because you can raise funds that somebody else couldn't do it.
Well, which raises an interesting question. I think back to the post-2008 era. When we were building in Philadelphia, we had a very difficult time getting, certainly no major bank would deal with us. We managed to find 4 community banks or regional banks that would deal with us. We ultimately selected Meridian Bank and did a bunch of buildings under a blanket commercial loan. And then they too hit a limit where they had, according to the regulator, too much concentration within the zip code. So they too could no longer lend, and we had to go seeking another lender. We found East River Bank and then DNB First and others. But what are your thoughts on spreading your risk around multiple lenders and having multiple lender relationships?
Great. Absolutely, absolutely wonderful. The more relationships that you have, and you happen to hit a very sore spot. That the sore spot is a lot of the regulators or that are looking at the banks are very short-sighted. You're right. They say you're overloaded in this asset. You're overloaded in this area. We don't like it. And that's totally arbitrary on behalf of either the bank or the examiners who go and look at the bank's records. Who's to say at this point, hey, you've been investing in years in a particular county or a particular city, and now all of a sudden you're overloaded. The city is going down. The bank that's totally unrealistic, but they have the power to do it. That's it. The little banks, the regional banks, are subject to many more regulations and restrictions than the bigger banks. It's interesting to know, and the more banks that you can deal with, the better it is.
I love my conversations with George. His advice is practical, and he cuts through the fog to get to the heart of the matter. At 94 years of age, George is extremely current on all matters relating to business. He remains well connected with business people from all over the world. By keeping his mind active, he stays young at heart. I'm very conscious that George is in the fourth quarter. I truly cherish these conversations. Now, if you don't have someone like George in your life, I really urge you to find someone of high caliber who can advise you in your business. If you'd like to talk to George yourself, you might be interested in joining my monthly conversations with him. If you'd like to learn more about how you can do that, send me an email to podcast@victorjm.com. That's podcast@victorjm.com. As you think about that, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.